They didn't ring a bell. They didn't call a press conference. But a quiet 180-day clock just started ticking, and when it hits zero, the silver and copper markets may not look anything like they do today. If you think this is politics as usual, you're already behind. Something unusual happens when deadlines appear in commodity markets. Prices don't wait for the deadline to arrive. They move ahead of it. And when the name attached to that deadline is Trump, markets pay attention whether they like it or not. A 180-day timer sounds harmless on paper. Half a year. Plenty of time. But in the world of metals, supply chains, contracts, and inventories, 180 days is a warning shot. It tells producers, refiners, traders, and governments that the rules may soon change, and whoever adjusts last usually pays the highest price. Silver and copper are not random choices here. They are strategic metals hiding in plain sight. Copper is the bloodstream of the modern economy. Power grids, electric vehicles, data centers, renewable energy, military hardware, and basic construction all depend on it. Silver is even more deceptive. People still think of it as jewelry or coins, but today it's an industrial workhorse. Solar panels, electronics, medical equipment, advanced batteries, and defense systems all rely on silver's unique properties. You cannot easily substitute it. You either have it or you don't. So when a 180-day timer is placed on these two metals, the message isn't aimed at retail investors. It's aimed at supply dominance. It's aimed at trade leverage. It's aimed at, quote, tutway plefsch. It's aimed at who controls the pipes that feed the industrial world. Trump has always operated on pressure and deadlines. He doesn't start with the final move. He starts with uncertainty. Uncertainty forces reactions. Reactions reveal weaknesses, and weaknesses create leverage. Markets hate uncertainty, but they hate sudden certainty even more. A clear policy shift announced overnight causes violent moves. A ticking clock creates something different. It creates positioning. Companies begin to stockpile quietly. Governments review strategic reserves. Importers renegotiate contracts. Exporters reconsider volumes. And speculators start asking one question over and over again. What happens when the timer hits zero? For copper, the issue is concentration. A handful of countries dominate global supply, and political stability is not guaranteed in all of them. Any hint of tariffs, quotas, or strategic stockpiling can tighten an already strained market. Demand isn't slowing. Electrification is accelerating. Grid upgrades are accelerating. Gitification is accelerating. Grid upgrades are accelerating. AI infrastructure is accelerating. Copper inventories were not built for this pace. They were built for a slower, more predictable world that no longer exists. Silver is even more fragile. The silver market is smaller, thinner, and more opaque. A large portion of silver supply comes as a byproduct of other mining operations, not primary silver mines. That means production doesn't easily respond to price signals. You can't just flip a switch and produce more silver. At the same time, industrial demand keeps creeping higher, while investment demand waits in the shadows for the right trigger. A 180-day timer acts like a stress test. It forces everyone involved to ask uncomfortable questions. What if imports are restricted? What if domestic production is prioritized? What if strategic reserves are built or expanded? What if pricing mechanisms change? None of those questions need answers today to move markets today. They only need to exist. This is where most people get it wrong. They wait for confirmation. They wait for headlines that say something definitive happened. But by then, the positioning is already done. The smart money doesn't react to the event. It reacts to the setup. And a public countdown tied to critical industrial metals is a setup that almost never ends quietly. What we are watching is not a policy. It's a process. A slow squeeze of expectations, a gradual tightening of assumptions, and beneath it all, a reminder that metals are not just commodities. They are tools of power, tools of independence, tools of pressure. And once the timer starts, it never really stops. It only expires into something new. Now that pressure begins to leak into pricing behavior in subtle ways. Not explosive moves, not headline-grabbing spikes, but quiet changes in how contracts are written, how inventories are reported, and how risk is managed. This is the phase where complacency still exists on the surface, but tension builds underneath. Traders tell themselves there's time. Executives tell themselves it's just rhetoric. Politicians tell themselves negotiations will smooth things out. And that collective calm is exactly what allows positioning to happen without noise. Think about how companies actually operate when a deadline like this appears. If you rely on copper for manufacturing, do you really wait until day 179 to act? Or do you start securing supply now, even if it costs a bit more? If you're a solar manufacturer dependent on silver paste, do you gamble that nothing changes, or do you quietly increase orders and inventory while you still can? Multiply those decisions across thousands of firms, and demand shifts before any official policy does. This is why spot prices don't tell the full story. The real action happens in futures curves, in delivery premiums, in warehouse drawdowns that look insignificant until they suddenly aren't. A few percentage points here, a delayed shipment there. Then all at once, everyone notices the same thing at the same time. Inventories are lower than expected. Lead times are longer, and the cushion everyone assumed was there is thinner than advertised. Trump's history matters here, not because of ideology, but because of pattern recognition. He uses deadlines as leverage. He uses ambiguity as a weapon. He pushes issues into public view, then lets the private sector scramble to protect itself. By the time an actual decision is announced, the economic impact is already locked in. Markets don't move on the announcement. They move on the anticipation. Copper is especially vulnerable to this dynamic because it sits at the intersection of old infrastructure and new technology. You can't build electric vehicles, charging stations, or data centers without massive amounts of copper. And those projects are not optional. They're already funded. They're already underway. That means demand is inelastic in the short term. Prices can rise and consumption won't immediately fall. That's the kind of setup that turns mild disruptions into outsized price moves. Silver adds another layer of complexity. It lives in two worlds at once. Industrial metal and monetary metal. Most of the time, those worlds ignore each other. Industrial demand quietly absorbs supply, while investors focus on gold. But when stress enters the system, silver has a habit of catching up violently. If industrial users start hoarding while investors wake up to supply risk, the same ounces are being chased by two very different forces. And here's the uncomfortable part. The silver market has a long history of underestimating its own fragility. Paper claims dwarf physical supply. Pricing mechanisms rely on the assumption that metal will always be available when needed. That assumption works until it doesn't. A 180-day timer doesn't need to cause a shortage. It only needs to raise the fear of one. Fear changes behavior faster than reality ever does. What makes this moment especially dangerous is timing. Global supply chains are already strained. Geopolitical trust is already thin. Governments are already talking about reshoring, friendshoring, and strategic autonomy. Silver and copper sit right in the middle of those conversations. They are not luxuries. They are necessities. And necessities don't stay cheap when uncertainty grows. Most people are still watching this like it's a headline risk, something to react to later. But markets that explode rarely do so from surprise alone. They explode from pressure that was ignored for too long, from signals that were dismissed as noise, from timers that were treated like theater instead of warning signs. And the closer that timer moves towards zero, the harder it becomes to pretend nothing is happening. Because the final phase is always the fastest, and it always begins when confidence still looks intact, right before perception flips. This is the moment markets are most dangerous, because prices still look reasonable, volatility still looks contained, and experts still sound calm. But underneath, behavior has already changed. Inventory decisions have shifted, risk models have adjusted, quiet accumulation has taken place, and once that shift happens, there is no rewind button. As the 188-day clock runs down, the conversation stops being about what might happen and starts being about what must happen. Governments don't set timers on strategic materials for entertainment. They do it to force alignment, to flush out dependencies, to identify choke points. And once those choke points are identified, policy doesn't need to be dramatic to be effective. Even small changes can have outsized effects when supply chains are tight and demand is non-negotiable. For copper, the end game is control and security. Whoever controls copper controls the speed of electrification, military readiness, and technological expansion. If domestic supply is favored, global flows adjust. If imports become uncertain, premiums rise. If strategic reserves are prioritized, available supply shrinks. None of this requires a crisis. It only requires direction. And direction is exactly what a countdown implies. Silver's end game is different, but just as powerful. Silver exposes the gap between paper markets and physical reality. It reveals how much confidence is built on the assumption that someone else has the metal. When industrial users and investors reach for the same limited pool, price discovery stops being smooth and starts being abrupt. Silver doesn't move gradually when it wakes up. It reprices, and it usually does it when most people are looking somewhere else. What makes this setup especially potent is that it doesn't rely on optimism. It doesn't need hype. It feeds on necessity and fear. Manufacturers don't buy copper and silver because they're excited. They buy because they have no choice. Investors don't rush into metals because of slogans. They rush in when trust in stability weakens. A ticking clock tied to critical resources quietly attacks that trust. By the time the timer expires, the market won't be waiting for an announcement. It will already have chosen a direction. Policies may confirm it, headlines may justify it, but the move itself will be old news to those who understood the process. This is how major commodity shifts always happen. Not with a bang at the start, but with a whisper that grows louder until it's impossible to ignore. Strong final conclusion. So this isn't about Trump. It's about timing, leverage, and reality. A 180-day timer on silver and copper is a signal that the era of abundance assumptions is ending. It's a reminder that critical materials are political, strategic, and finite. Markets can ignore that for a while, but they can't ignore it forever. The smart money watches the clock, not the headlines. Because when the countdown ends, it won't feel like a surprise. It will feel like inevitability.